Good morning and welcome to the VSA Morning Miner. I'm Ollie O'Donnell and joined by Paul Rankin. Paul, how are you today?
Pretty well, thanks. Pretty well. How are you?
All good, thank you. We've got quite a bit of news today. A few results, a few other releases. If we start with the biggest companies and work our way down, I think.
Okay.
News yesterday that Peabody have pulled out of their bid for Anglo's coal assets in Australia. There was a mine fire, and Peabody had hoped for a reduction on the price as a result. I think this might be looking like a legal process, as Anglo don't necessarily agree that there was any clause for terminating the acquisition as a result of that fire. But obviously creates further uncertainty for Anglo's restructuring, on top of De Beers, etc. We've also got interim results from kenmare.
Yes, that's right. Half year results for the period ended June 30 showed mineral sands production revenue at just under $160 million for a 3% year on year increase. But the adjusted EBITDA was at 47.2 million, which represents a 30% margin, but that's 25% poorer on a year on year basis due to higher operating costs. Adjusted profit after tax, not very high at all, just $6 million, which is down 71% year on year. They did declare an interim dividend of 10 cents per share, but their cash operating costs had increased to $248 a ton, which is an increase of 14%. Net debt stood at $85 million. They have about $47 million in cash and $70 million in undrawn credit facilities. Year on year increase of 1% on total production in tonnage, and the total finished product production was just over 500,000 tons for a 2% rise. They are still feeling the angst around the renewal of the MoMA implementation agreement, the MoMA mine, by the Mozambique government. I can understand that since they've got this new wet concentrator now at 60% completion, and if they can't don't have a surety that the operating plan is renewed, then it puts definitely some uncertainty under shareholders' eyes.
Yeah, certainly that renewal has now been going on for about 3 years, and it extends the original 20 years of operation by another 20 years once agreed. The company has offered a higher royalty, a percentage point higher to 3.5%. And as a result of that, they took $100 million impairment in these results, non-cash obviously. And there's even mentioned that the company are now starting to consider things like arbitration if they aren't able to get an extension,
Mm-hmm.
given the potential losses. So certainly a weight on the share price for the time being. Also note that the capital spend for this year is increasing to $165 million, up from 150, but that is rescheduling capex. The project budget is still $341 million for that wet concentrator, and looks like production guidance is still the same, with it with volumes expected to be higher in the second half.
Mm-hmm.
With rare earth fever very much in swing, Lindian Resources have done a raise, Paul.
Yes, that's right. A really good result here for Lindian Resources. 91.5 million Australian raised in equity. well oversubscribed, and the selling price on shares as offered was 48% above its 20-day average selling price. So well done to the capital raisers there. This assures the full funding for the Kangankunde rare earth deposit, and that deposit is otherwise in joint venture partnership now with Iluka Resources, who is providing both offtake and debt finance. So well done them.
And a brief update on the plant progress from Prem.
Yes, that's right. They have completed the second phase of the OEM plant test run, and they have been able, with that test run, in order to produce several numbers of samples which are above what is considered commercial grades of spodumene concentrate, as high as up to 6.2%. Now, the idea is to make sure that the uh, primary flotation plant is optimized such that it can run continuously in order to produce these grades of concentrates, because that is the requirement for commercial viability on Zulu.
Excellent. Great. Thanks, Paul. We'll be back tomorrow.
Very good. Thanks.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.